March 13. Okay, I'm going to go over, we have FOMC this week. In my gut, they should raise rates because the market says so. But if they don't, I think things are going to pick up in a hurry. Then my tone will change from they should be doing it to they're going to have to double do it. But that comes down the line when you have to kind of cool things down a little bit here, because I just expect stocks to go up at least another, even I just farther. You already know that. So, okay, so let's just go through some of this here. Here's Japan, right? Okay, we're dealing with a negative interest rate. These are weeklies. This is a weekly bar. I want to point something out to you. This would be known as an outside reversal, all right? The interest rates traded even more negative and closed higher than the previous week. Okay, and this is, like I said, this is a weekly bar, so it traded lower early in the week and then came back. All right. Up here, the purple line, we have the ADX. It's just screaming. The angle of descent is pretty sharp. Okay, it's not a logged chart, but it just looks pretty scary. I have to believe that there's not going to be much more down here in Japan, because however this inflation starts to pick up and actually show up on things, we have a shortage of like wholesale inventories and stuff too. Okay, so there's definitely gonna be a pickup here. Okay, and people are kind of slow to get off the couch after sitting around for 7 years. All right, so I think, just to reiterate, I think the Fed has to raise rates this week to get in the game here. But like everything else, they lag too. So, but that's fine. But down the road, don't be, what is the wiser on a half-point move. But like I said, that's usually, like right now, percentage-wise, it's pretty steep. But linearly, it's nothing. So, okay, so we have Japan. And then we move down to the Germans. Okay, the first little pointer of all of this goes back to a year ago when interest rates came down, and all of a sudden they just took off screaming again. All right, now we had a year's worth of coming back down, but now they're working on another program, a little bit of corporate cronyism there, buying that debt, and we're beyond maximum priced on this stuff, right? So everybody gets a little piece of the pie here. It does trickle down into insurance companies. People have their annuities, things of that nature, so the trickle moves a little bit quicker. Interest rates, obviously, on these weekly bars, again, going the other way. All right, so they say one thing and do another thing. ADX hasn't turned up here yet, but, okay, so watch the German rates on a daily. Here's our Fed funds. This is what they raise here. This is a monthly bar. Do you see that we've come off the low interest rates and it's doing nothing but going up? All right, right now here for this month, this is list February, yes, because of the March, 12%. All right, so interest rates change that moved at about 12%. All right, so this is what they're hiking. They're hiking the front end. I don't expect it. Well, I do expect it to affect the back end because of the shakeout in equities in January and February, cause people to run into debt. Here's the 1 year. This is back to the front end. That does not look like it's on pause. That does not look like it's listening to the FOMC at all. So 2 year, this basically the same thing, but it begins to wane down here because everybody jumping into debt. And let me get down here to, okay, so here is the UK. Same principle as other parts of Europe. This Brexit is working out just swell. It looks like they jabbed the 130. In theory, it's on its way up to this R1 here. But it doesn't look like it's going down either. So, like I said, those powers that be say one thing and something else is happening. Okay, 7 years picking up. The only one that I see that ran into something was the 5 year, I believe, and it ran into the cloud here. Okay, so there's the yield curve. Take a look for it for yourself there. And once again, thank you for